So you're preparing for investment banking interviews, which is one of the most competitive and high pressure processes out there, where the difference between getting an offer and going home often comes down to how well you understand just a few key concepts and how you can deliver them under pressure. But with so much advice out there, it can be overwhelming to know where to even start. I've interviewed hundreds of candidates in my M&A career, and so in this video, we're gonna go through exactly what you need to focus on so that you can prepare fast and walk into your first round or super day ready to perform. So let's get into it. One of the things that's gonna come up time and time again during the process is questions about what is investment banking and what do bankers do? Because people have an idea of what investment bankers do from movies in the media, and the word investment in the word makes people think that they're actually going to be investing dollars into stocks. None of that is true. That is not the case. And so throughout the process, you need to make sure that you are crystal clear on what it is that investment bankers do so that there's no surprises once you start the job. At its core, what investment banks do is raise money for clients, either debt or equity, potentially through IPOs, or they are strategic advisors for M&A, mergers and acquisitions. And the way that I think about an investment bank's role in an M&A process is similar to what a real estate agent does when you sell your house. If you own your house, you theoretically can turn around and find a buyer and not need to share the commission with anybody. However, you probably don't know people who have the money that are looking for your type of house or how much your house can even be worth. And so you hire a real estate agent to tell you how much your house is worth and connect you with buyers in the marketplace. Once you find a buyer, you sell the house, take all the proceeds, and then share a commission with the real estate agent. It's the same thing with an investment bank, but when you're selling your company. If you are an entrepreneur and you've built a company, your expertise is in that company. When you decide that you're ready to sell that company, you probably don't have any expertise as to how much your company is worth or who even is out there that you could sell to. And so similar to the real estate agent, you would go through a process where you interview an investment bank to be your agent and represent you on your behalf and manage a process for you. In that process, a group of banks will tell you how much they think that they can sell your company for and who they think might be the best buyers for it. And during this pitch process is when you as the entrepreneur would select who your investment bank is going to be to represent you, and then that's where the work really starts for the bankers. As far as the job goes, an investment banker builds detailed financial models to represent what your company can do for a potential buyer, and they will build marketing materials that explain exactly what it is that your company does so that a potential buyer can read through a detailed set of materials without disrupting the entrepreneur. As that initial process goes through, the buyers will have questions, which is a part of a due diligence process. And so the buyers will ask the bankers specific questions about the company and potentially need to set up calls with the company in order to go through what those answers. The banker is there throughout the entire deal process, all the way through the negotiations of the final documents and coordinating all of the logistics between a potential buyer or seller in order to make sure that the transaction is successful. As far as the actual interview goes, there's two components, the behavioral and the technical portion of the interview. On the behavioral portion, there's a whole suite of questions that you can be asked to see whether or not you're the right fit. But in every single interview, you will be asked these same questions, and it's helpful to walk through what those three questions are. The first one is walk me through your resume, which is basically tell me a story about yourself in 1 to 2 minutes so that I know who you are and can remember why it is that you got to where you are today. And there's a lot of videos on YouTube that you can listen to about how to walk me through your resume. But basically, you want to be able to paint the picture for where you were in the past, how you got to where you are today, and what it is that you're looking to do in the future. Most people who are interviewing for investment banking do not have any experience in it. And so you want to be able to draw a line from what your previous experiences were all the way up until how you got to where you are sitting before the interviewer today. And this is going to be how every single one of your interviews starts off with. So make sure to get this story tight because this is your initial pitch. The next question that you're always going to get is, why do you you want to do investment banking. And for the love of God, in an interview, please do not say that it's about the money. Even if it is about the money, you can't say that. One of the things that you just need to know throughout the process is that you can't say that. And you would be surprised at how many people I've interviewed that said that they want to do investment banking because they want to make money and live in New York or Los Angeles or wherever it is. So please just don't say that. You really need to think about why it is that you want to do that. Now, I will say that in investment banking, you will have access to be behind closed doors where $100 million decisions are being made at a very young age. And for me, that's why I wanted to do investment banking. But also throughout the program that you're going to be a banker, it's really a wide range of skills that you're gonna be able to develop that will go beyond just banking. A lot of people think that the skills you're gonna develop are just financial or analytical, but banking is really more sales and marketing based than a lot of people give it credit for. Because you're going out and selling businesses, you're going to need to build out a marketing skill set and how to actually get on the phone with people and sell your business to potential buyers, where it becomes more and more important the more senior you get, to the point where by the time you become a director or managing director, you're doing very little finance at all and mostly sales and bringing in new business. And so I think that the toolkit and the skill set that you get from investment banking is much broader than people think, and is one of the key reasons why it makes sense to go through the junior banker program. And the last question that you're gonna get throughout each process is, why XYZ firm? And for this one, you need to do your homework in order to have a good answer for it. What I recommend doing is researching specific types of deals that that bank has specialized in or focused on, and be able to convey a story for why it is that you're interested in doing those types of deals. Banks are broken into basically 3 different buckets. The first bucket is bulge bracket banks like Goldman Sachs, JP Morgan, Morgan Stanley. The second is middle market banks like Houlihan Lokey, Lazard, and Jefferies. And the last bank is boutique banks like Centerview and Evercore. For bulge bracket banks, you will be exposed to a wide range of transactions because they can support all types of deals. You will do sell-side M&A advisory, buy-side M&A advisory, debt raises, equity raises, and the suite of potential deals that you can do increases dramatically at a bulge bracket bank versus middle market or boutique banks. At boutique banks, you will focus specifically on a couple of types of transactions in specific industries. At Centerview, you will join a group where you can be on the technology team and work on some of the best technology deals out there, because that is what that group specializes in. At a middle market bank, you're getting a little bit of the best of both worlds between the larger bulge bracket banks and the smaller boutiques, where you'll get to work on meaningfully sized transactions, not enormous, but not tiny deals, and you will be able to feel more so like you're part of a smaller, tight-knit group than you would at a bulge bracket firm, where you're more of a cog in the machine that gets churned out. And so you'll get the chance to work on larger deals, but less of a range of deals at a bulge bracket bank, but more of a range than you would if you were at a boutique. All right, so the technical portion of the interview is the most notorious and the most overwhelming for most people that go throughout the process. And the reason is because you can be asked such a range of questions about finance, valuation, investment banking, that people don't know where to start, and they try to just memorize answers from a 500 question guide where they can regurgitate information but not truly understand why the answers to the questions are the way that they are. And so in this portion of the video, we're gonna focus on boiling it down to the core things that actually matter for the process. And make sure throughout this that you really take the time to go over and understand these 4 concepts, because once you understand these concepts from that perspective, you're gonna be able to answer just about any question that a banker will ask you during the interview process, because they all stem from understanding these 4 things. And the first thing is to have a deep understanding of the 3 accounting financial statements, which are the income statement, the balance sheet, and the cash flow statement. And they're all important, they all play together, but it's important to understand what each of them does. And so, starting with the income statement, which is a profit and loss statement that tracks how much money a company made for a certain period of time. Over the course of a certain period of time, let's call it a year, you'll be able to track how much revenue and cost the company made during that period, so that they come to an eventual profit. And stepping through the income statement is revenue at the top, total gross sales. Underneath that, you have the cost of goods sold, which will bring you down to your gross margin. After gross margin, you have your operating expenses that are taken to run the business, which brings you down to operating profit or EBIT. After EBIT, you take out your interest and taxes to work down to net income, and that's the way that an income statement works. That net income flows into the next statement, which is the cash flow statement, to track exactly what you might think. How much cash throughout the same amount of time period flowed throughout the business. The first line on the cash flow statement is net income, and then underneath that are adjustments for other cash flow items that didn't necessarily appear on the profit and loss statement. For example, depreciation and amortization is an expense that hits on the income statement that lowers what your net income is, but depreciation and amortization is not really a cash expense. You know this because you have a car, and when you bought your car, it had a certain value, but as soon as it came off the lot, the depreciation of it came down. After you bought the car, there wasn't any cash exchange that made it less valuable. It's just the overall depreciation on it. Same thing with a business. Depreciation and amortization shows up as an expense, but it's not a cash flow item, and so you would add it back on the cash flow statement. Another item on there is capital expenditures, which are significant expenditures by a company to invest in the overall growth of the business. Oftentimes, these are one-time in nature, and so they don't show up for some reason on the income statement. And so if a company were to buy a new property or a new office building, you would consider that a capital expenditure, and that expense does not appear on the income statement. But since you used cash for it to fund it, it needs to show up somewhere, and it goes on the cash flow statement. And lastly, on the cash flow statement, it's cash flow from financing activities. And so if a business goes out and raises more money from banks, let's say a business goes and takes out a $100 million loan, that would not show up on the income statement, but that's $100 million of new cash to the business. And so that would appear on the cash flow statement. So with the income statement and the cash flow statement working over a certain period of time, call it a year, to track what revenue, expenses, and cash flow items are, the balance sheet is a snapshot. It is a full accounting of the assets, liabilities, and shareholders' equity of the entire company at a certain point in time. And so while an income statement or a cash flow statement might be for the past 12 months, a balance sheet would be as of today. The way that the balance sheet connects with the income statement and cash flow statement is the same thing. It goes back to net income. And so for every transaction that occurs throughout a business, the balance sheet needs to stay in balance. And so the way that the balance sheet connects to the income statement is through net income. That net income would flow into the shareholders' equity side as retained earnings, and the incremental cash that they got from those transactions would make cash go up so that the balance sheet always stays in balance. On the cash flow statement, cash would go up or down based on what activities happen. So over the course of a year, let's say cash went down $100 million because we bought a new property. So cash would go down by $100 million, but your assets would go up because you got the business as a result of it. And so at the end of the day, all three of these financial statements are always working together, and the balance sheet is a snapshot that takes all of the activities that happened across the income statement and cash flow statement to ultimately end up in balance. Now, the next section for technical interviews where you'll get a lot of questions is free cash flow. If I could boil down finance to one term, it is free cash flow. Finance is the entire study of free cash flow. And so in investment banking, you're gonna be asked a lot of questions about what it is. And starting with unlevered free cash flow, which everyone memorizes what the formula is, it is EBITDA minus CapEx minus the change in net working capital. It's one thing to regurgitate the formula for unlevered free cash flow, but it's another thing to really take the time to understand what it is. Conceptually, unlevered free cash flow is the total cash flow available to all stakeholders of the company, the shareholders and the debt holders. Now, why is that important? It's important because you want to be able to compare companies on an apples to apples basis. The fact that one company has a lot of debt and needs to pay a lot of interest expense, and one company has no debt and zero interest expense doesn't necessarily mean that one company is better than the other, right? For whatever reasons, they could have gotten bad terms on their debt or great terms, but it doesn't make a company intrinsically better than another. And so unlevered free cash flow is a way to just take this out of the equation and look to see, okay, regardless of what a company's capital structure is or how much cash flow would the company bring in, so that we can evaluate how good the entire company is. And when you're trying to understand what cash flow is, it's easy to go to the income statement and think, okay, just revenue minus expenses is going to be the net cash flow of the business. But that's not necessarily the right way to think about it. And so EBITDA is the valuation metric that everybody starts with when you're looking at free cash flow instead of net income. EBITDA is earnings before interest, taxes, depreciation, and amortization. And the reason why you don't want to include interest, we've already talked about, is because one company could have financed their debt at a certain percentage rate, and let's call it 10%, and one company could have financed their debt at 5%. The company that's paying 5% interest would be able to make more money, but whenever that debt comes to maturity, they're gonna need to refinance, and then it could be at 15%. And so it's just financial engineering and not necessarily a true metric of what company is better than the other. Taxes can depend on a lot of things. It can depend on the state that you live in, the country that you're in, whether or not you've lost money in the past. And judging whether or not a company is good or not should not depend on where it is in the country that they reside, because taxes are taxes and they can change at any point in time. And so when you're looking at the true cash flow of the company, you want to strip that out and think about what the cash flow is before that impact happens. Depreciation and amortization, we talked about earlier, is an expense that runs through the income statement and would lower profitability, but it's non-cash in its core. And so when you're looking at the income statement and trying to determine what cash is flowing from the income statement, you need to adjust out those non-cash expenses because you're only interested in what free cash flow is for the company. And so you need to add that back. One of the trick questions that comes up is why you need to subtract out CapEx from unlevered free cash flow, because capital expenditures don't show up in the income statement. It's a cash flow statement item. And so making significant investments into getting a new building, significant new equipment, research and development are all significant cash flow expenses that just would not show up on the income statement if you didn't adjust for them out. For whatever reason, capital expenditures are not an income statement item. And so when you're calculating unlevered free cash flow, if you start with EBITDA, you will not be capturing the impact of CapEx. And so you need to subtract that out from free cash flow. The change in net working capital is balance sheet items. And so if I were to buy $100,000 of office supplies using cash, the accounting transactions would be cash goes down $100,000 and office supplies go up $100,000. That is a balance sheet transaction. And so if that was the only transaction that happened over a period of time, my cash flow would have gone down by $100,000, but since it's a balance sheet item, it would not appear on the income statement. And so the change in net working capital takes your current assets and current liabilities over a period of time and consolidates them over that period. And the change over any certain period of time will reflect what the cash flow impact is that happens from the balance sheet. And so when you're thinking through the equation of what unlevered free cash flow is, you need to think about what the impacts are from the income statement, what the impacts are from the cash flow statement, and what the impacts are from the balance sheet. That will get you a comprehensive view of the free cash flow profile of the firm. When it comes to understanding the levered free cash flow, which is just the cash flow that's available to shareholders, you're not interested in what can potentially be available to the debt holders. And so where you start at is net income, because you're subtracting out the taxes and interest expense that would have been due to other stakeholders, which would be the debt holders and the government. So by starting with net income, that's all that's available just to the shareholders of the company. Same thing, you need to add back depreciation and amortization because they're non-cash expenses, and then subtract out CapEx and your change in net working capital. So the equation for levered free cash flow is just what's going to be available to shareholders and is net income plus depreciation and amortization minus CapEx minus your change in net working capital. The other key thing you're going to be asked about during the technical part of an interview is what the difference is between enterprise value and equity value, and when to use each. Enterprise value is the total value of the firm. Basically, everything that's available to the shareholders plus everything that's available to the debt holders. What's the total value of the company? Whereas equity value is going to be just what's available to the shareholders of the company. When it comes to understanding when to use enterprise value versus equity value, it depends on what you're trying to accomplish. If you're trying to figure out what the total value is of the company, you would use enterprise value, and in your valuation, you would use unlevered free cash flow, because remember, that's the cash flow that's available to all shareholders in the firm. If you just want to run an analysis on what the value is to the shareholders of the company, you need to use levered free cash flow. You can use a DCF for both of these, but in the enterprise value case, you use unlevered free cash flow and discount using the weighted average cost of capital. But in the equity value case, you use the levered free cash flow and you discount back only using the cost of equity. When you have your enterprise value, you can divide that by revenue and EBITDA multiples, which is going to be your basis to compare different companies as far as valuation, so that you can right size it for how big that the company is. If free cash flow is how you summarize finance in one term, then the way that you summarize mergers and acquisitions into one term is valuation. And you will be asked about the 4 different valuation methodologies and how it is that you do them. Starting with the first one, which is discounted cash flow. In order to measure the valuation of a company based on the intrinsic value of its cash flows, which basically means that a company is worth the amount of cash that it can generate. And the way that you do that is you start with unlevered free cash flow, EBITDA minus CapEx minus change in net working capital, and project that out over a period of time. You discount all of those future cash flows back to the present value using the weighted average cost of capital, which basically takes into the account the idea that $1 today is worth more than $1 tomorrow. And you know that intrinsically, because if I were to offer you $100 and tell you that you can have it today or you can have it 1 year from now, you would take out the risk and take the $100 today. And so if you're projecting out future cash flows, one of the core parts of financial theory is that $1 today is worth more than $1 tomorrow. And by using the weighted average cost of capital, which is a blend between a company's cost of debt, which is their interest expense, and their cost of equity, based on the weighted average of how much debt and equity the company is made of, then you can discount those future values down to the present date so that you can get an ultimate value of what the company is. The way that you would run the DCF is that you would project out cash flows for 5 years, and in the 5th year, you would apply a terminal multiple, let's call it 10 times EBITDA by the last year's EBITDA, and then discount that future value down to the present so that you can have an idea of what the entire value is of the firm. After the discounted cash flow analysis, you have the public company comparables analysis, which is basically the idea that a certain company would be worth the same amount on a multiple basis as other companies that it competes against. So what does that mean? If I put this into plain English terms for you, going back to the real estate analogy I was using before, if houses in a certain subdivision are trading for a certain amount of dollars per square foot, then it's a fair assumption to say that any other similar house within that subdivision would trade for the same dollars per square foot. If you are a real retail company and you're trying to figure out how much this retail company would be worth, you'd probably look at other big similar retail companies. Walmart, Target, Kmart, whatever other kind of public companies there are that are doing retail, and you would aggregate them and see what their EV to EBITDA multiple is, total enterprise value divided by EBITDA, and just take an average or a median of what that number is, and that's a fair assumption for what you can apply to the retail company that you're looking at. Bringing us to the third valuation methodology, which is similar to public company comparables, it's M&A precedent transactions. And if we're thinking about the same retail company and trying to figure out how to value it, we might look at what other similar retailers have just sold for. And so you would compile a list of other M&A transactions that have happened that are similar to the retailer that you're talking about selling. And same thing, you'd come up with a list of 10 or 20 of them, and then you would get the median EV to EBITDA multiple for what it sold for, and then that would be a way to value the company. M&A transaction comparables will have a higher valuation than public company comparables, because if you're going to acquire an entire company, you're gonna need to pay more than what the actual day's trading cost is, or else you're not gonna get the shareholders to sell them. So if you are trying to buy a retailer and the total stock price is $100 per share, if you offer $100 per share to every single shareholder, you're probably not gonna get enough of them to sell to you so that you can buy the entire business. If you want to buy this public company, you're probably gonna need to offer $120 or $130 per share so that every one of the shareholders has an incentive to sell to you. And so that valuation is gonna be significantly higher than the public company comparables. And the last valuation methodology is the LBO methodology. And an LBO, which is a leveraged buyout, is what private equity firms use when they decide to acquire a company. And what the key concept of an LBO is to use debt in order to acquire the business. So why would a company want to use debt instead of just using cash to acquire the business? The same reason why when you decide to buy a house, you would use a mortgage in order to do it. So there's a couple reasons why. Number one is you need to put less of your own money up front. And if you think that the company is gonna grow in the long term, then you'll be able to sell the business, pay down the debt, and then make more money. So if you have let's say you have a $1 million company. If you pay $1 million in cash for it, 5 years from now, that company is worth 1.2 million and you sell it, congratulations, you made $200,000 or 0.2 million. In an LBO, what you could do is for that $1 million company, maybe you put 25% of your own money in and 75% of debt in order to fund it. So you put in $250,000 of your own money. 5 years from now, that company is worth $1.2 million. And then when you sell it, you'll pay down your $750,000 in debt. And so once you subtract out $750,000 from 1.2 million, you have $450,000 that you made. $450,000 divided by the 200 minus the 250K that you put in is $200,000, and congrats, you made just as much by putting in less money than you would have if you bought the whole thing. So with the extra money that you could have had, you could make extra investments so that you can keep getting those returns quicker. In an LBO, the key thing is that a private equity firm is going to use debt and bet on the company growing so that they can sell it and use their equity more efficiently so that they can make higher returns. As far as the 4 valuation methodologies go, typically the discounted cash flow is the highest valuation because you're using free cash flow and you're using aggressive assumptions to project it to show why that company is worth more than other companies in the space. The next highest valuation will be the M&A transaction comps because you need to pay a premium above the public company comparables in order to get them to sell. So the number 3 is the public company comparables, and then last is the LBO because private equity firms are looking to make investments where they can't have any synergies. And so if there's no other strategic buyer who would theoretically be willing to pay more, a private equity firm would come in and do an LBO so that they can get the best deal possible when they're making their investments. So I know this was a comprehensive overview of what the process could look like, but it's important to understand what these core concepts are because there's a million different questions that you can get throughout the process, but they will all stem from these 4 things. And so what I recommend doing is go through these, make sure you really nerd out and understand why things happen the way that they do. And once you do that, as you prepare for the interview, what I like to do is just close my eyes and reduce the stakes. You don't want to be in a position for the interview where you're reciting memorized lines. What you want to do is just have a conversation with the person across from you. And if you really understand these financial concepts and really study them, it should come across as naturally when you're you're talking to somebody. I know this whole process is stressful, but try to make sure that you take a deep breath and understand before you go into the interview that it's really not that important. It would be great, and I know that you've been working to try to get this job, but if it doesn't work out, it's not the end of the world. There's a million ways to make $1 million. And so try to approach it with the mindset that you're doing the best that you can. And when you have the interview, just have a conversation. And if it goes great, you'll move on to the next round. But if it doesn't go great, there's gonna be other opportunities for you out there. There's gonna be other opportunities for you. So do the best that you can, have fun with it, and try to focus on what's important so that you don't end up going down a rabbit hole and spending hundreds of hours studying stuff that you don't need. And so if you liked this, make sure to like the video and subscribe to the channel.